A very good morning to one and all present here. Thank you so much for joining us on a Saturday morning, taking your time out to attend this webinar. Team iThought is pumped up today to talk to you all about taxes to help you keep calm and conquer your taxes. Often, we tend to ignore the tax planning part. In the beginning of the financial year, we say that we can do it later and we postpone this activity and we keep it till the last moment. Come the month of January and February, we are confused on to what to do for tax planning. We are also confused if we are doing the right thing. That's the reason we have the webinar today in the month of February to help you plan your taxes better, not only for this financial year, but also for your subsequent financial years so that you can learn and make the right decisions in the beginning of the financial year itself. With that note, I would like to introduce the speakers and panelists for today. We have our speakers Gaurav and Ganesh, as you may see on the presentation on the video. And we also have our panelists who will be joining us for the Q&A session. Our speakers for today, Gaurav and Ganesh. Gaurav is a qualified chartered accountant. He's also an investment manager with ithought PMS. Ganesh is a qualified cost and management accountant. He is a product manager with ithought PMS. Over to you, Ganesh and Gaurav, to start and rock the presentation today.
Thank you, Srimati. So, good morning, everyone. Thank you for joining us today. So, I would like to start off this webinar quoting Albert Einstein. He actually said that the hardest thing in the world to understand is the income tax. What this quote might actually denote is not Einstein's inability to grasp the concept of income tax. It just denotes the complexity with which income tax laws are framed that make them harder for anyone to comprehend and to be applied practically. So with this webinar, we want to take you through the concept of tax planning. So what is tax planning? It is planning to minimize your taxes and optimally utilize the income tax provisions available to you. But why do we need to plan? Everyone knows that this will help increase our savings, bring more discipline in our ways of investing, and help us build a corpus for our future. So the next question in all your minds would be to how to do this, which is what we would be looking at in this webinar. So let us understand this better with the help of a story. So meet Mr. Karthik and Mr. Anil. They are co-workers. Both are working in Chennai and both are about 30 years old. They both work for the same company and their CTs is also similar. It is around 24 lakhs. Let us look at the journey right now. Over to you, Gaurav.
Thank you, Ganesh. Good morning to all and thank you for joining us today. Most of us do a very common mistake when we calculate the take-home salary. We divide the CTC by 12 months. No, that is not right. There's a difference between CTC and the gross salary. CTC is the amount that an employer will spend on an employee in a particular year, whereas gross salary is the amount an employee receives as a salary before any deductions. Before moving forward, let us put some light on what are exemptions and deductions and how are they different from each other. Exemption can be an income which is not taxable. For instance, under the head income from salary, you can claim an exemption for house rent allowance, leave travel allowance, etc. Whereas deductions help to reduce some amount from your income and thereby reduce your tax liability. This amount is based on certain investments or expenses you make in a financial year as per the Income Tax Act. An easier way to avoid this confusion is by a simple formula. Your earnings minus exemptions is equal to your taxable income, and from your taxable income, you remove the deductions, you get your net taxable income. It is very important to reduce our taxable income to reduce overall tax liability. Hence, optimizing the salary is very important. In our case, both Karthik and Anil have similar pay slips. They are receiving house rent allowance, leave travel allowance, and food coupons from their employer. In this example, after you apply the deductions like employees' provident fund contribution, professional tax, and TDS, we get the take-home salary. Each salary slip starts with basic and DNS allowances, and then some allowances like HRA, LTA, food coupons, etc. The most common allowance all of us know is HRA. HRA is nothing but what is received from the employer will qualify for exemption if the employee lives in rented accommodation and pays rent to the owner. Under the leave travel allowance, salaried taxpayers can claim expenses incurred towards domestic travel, such as the expense of travel tickets for self and family. Expenses like shopping, food expenses, lodging, entertainment, etc. cannot be claimed. This exemption is available only for 2 journeys in a block of 4 calendar years. Let us further understand how Karthik and Anil manage their taxes. Both of them stay in a rented accommodation in Chennai, and they have their own houses in their hometown, Patna, where their parents are staying. Karthik has not claimed any of the exemptions and has not submitted proofs as well. For instance, he was unaware of the fact that he can claim an HRA exemption on his rented accommodation, even though he has his own house in his hometown. As a result, his gross taxable income post standard deduction is approx 21.45 lakhs. On the other hand, Anil has utilized all exemptions applicable in his case. He's also submitted the proofs for claiming the exemption. Anil's income after claiming exemptions and standard deduction is around 16.86 lakhs.
Thank you, Gaurav. So with the previous slides, it shows us that it is all the more important for us to submit our proofs at the right time. So now we've looked at how we can use our exemptions in the Income Tax Act to minimize your tax liability. Now moving on to deductions. If you look at the deductions, they can be found in Chapter 6A of the Income Tax Act. This chapter contains sections from ATC to ATU. We all know about these deductions, but we want to highlight certain key points that you should know when you claim deductions under Chapter 6A. Before going forward, we would all like you to take part in this poll that appears on your screen. Okay, thank you. So moving on. So we all know that under ATC, we can claim our life insurance premium and the ceiling limit of that 1,50,000, which is applicable to the section on the whole. However, many of us tend to miss out on this point that claiming the life insurance premium paid for our spouse and children, that too is allowed under ATC. So here it is important to note that this does not apply to the premiums paid for your parents. So we all talk about PPF being an excellent investment option to accumulate your retirement corpus. And we all know that it has a lock-in period of around 15 years. However, what we all fail to note is that it is possible to extend your PPF indefinitely after 15 years. And this, please note, this can be done in blocks of 5 years each. So beyond 15 years, beyond your initial lock-in period of 15 years, you can still extend your PPF indefinitely in blocks of 5 years. And if you plan to invest in PPF in installments, then we suggest that you should do it before the 5th of every month in which you invest. So according to PPF rules, the interest on PPF deposits is calculated on the lowest balance between the 5th and the end of the month. So this effectively means that if fresh deposits are made between 5th of each month, you get the interest for that month on that deposit. Otherwise, interest is usually calculated on the previous balance. Hence, one can consider investing their money before the 5th of every month to get the maximum amount of interest for their deposits. Moving on to EPF now. There is a common misconception that we all tend to take in the case of EPF. We assume that both employer and employee contributions can be availed as deductions. However, please note that only for EPF, only employee contributions are considered. This means you would not be able to take your employer contributions as deductions. Now moving on to the Suganya Samriddhi scheme. So Suganya Samriddhi scheme is a saving scheme that encourages parents to build a fund for their future education and marriage expenses for their female child. This is something that we all commonly know. But there is something for you to keep in mind in this case. To be eligible for opening a Suganya Samriddhi account, the maximum age of a girl child, of your girl child, is 10 years. So let me give a minute for you all to process the information on screen, and then we will move on to the next point. Okay, thank you. So moving on to section 80D. 80D again is an important section for all of us, and most of us do the right thing by claiming it right. However, there are certain points that we tend to miss out. Before going forward with that, we would like you to take part in another poll that appears on your screen. Okay, moving on. Okay, under 80D, we all know the common deduction of medical insurance, that premium that we actually pay through 80D and claim through 80D. But we need to note that critical insurance premium can also be claimed under this section. And you can also claim a preventive health checkup deduction for up to rupees 5,000 per financial year. A lot of us miss out on this point. It is very, very important to keep in mind that this 5,000 is included in the overall ceiling limit available for 80D. Moving on to 80CCD2 now. This is on the contributions made by an employer towards an employee's pension funds under 80CCD2. So the deduction that you can claim under this section is limited to 10% of the employee's basic salary plus the earner's allowance. Please note, in this case, the deduction can go up to 14% of basic salary plus DA for government employees. Okay, moving on to the next slide. Okay, so these are other common deductions under Chapter 6A that are pretty well known and understood. So if you look at 80E, it talks about the deduction that you can claim on the interest that you pay on your education loan. So please note that this is available for deduction in full. There is no ceiling limit on this deduction. If you look at ATG, it talks about the deduction that you can claim on your donations to notified schemes, which is available up to a percentage based on the applicability. This is again a very common scheme that is pretty well known to all taxpayers. Moving on to ATTTA, it is a deduction that you can claim on the interest on your savings accounts, and it is available up to a ceiling limit of 10,000 rupees. Please note that this is available only for individuals and HUFs. So let me give you a minute to process these sections as well before we move on to the next slide. I think we are receiving a few questions from our viewers. So what we would suggest is once the presentation is over, we would have a Q&A session where we would be taking you through the questions that has already been submitted to us through our registration form. Anything beyond that, you can always take it up with us. We have our contact numbers and contact email IDs ready at the end of the presentation. You can always get in touch with us and clarify your doubts. And there is a question from one of our guests. Yes, you can get the deck for future reference. We would be making it available. We would get the recording as well so that you can go through the presentation once again at your leisure. Okay, moving on to the next slide. Okay, this is a pretty interesting part. These are the lesser known deductions, especially section ATEEB. Section ATEEB talks about the deduction that you can avail for your interest payments for up to 1,50,000 for loans taken for purchasing electric vehicles. So in today's world, every one of us wants to contribute to the environment. We all want to take part in some small way possible, however small it may be. This has actually contributed to the rise of electric locomotives. So section ATEEB, this talks about the deduction available for individuals having an electric vehicle for personal use to claim the interest paid on the vehicle loan. This would be a very, very important section for you all to take note, because with the advent of e-vehicles or to be a part of the overall environment. They care about the environment and they want to contribute in, as even if it is very small, they want to contribute. That is how. So section ATEEB facilitates this for most of us. Moving on to section ATU and ATDDB, they talk about the medical treatment for people with disabilities and for people with specified ailments. So as you can see, ATU has a deduction of up to 75,000 in case of persons with disability, and in case of severe disability, the ceiling goes up to 1,25,000. In case of ATDDB, it is for a self or dependent with respect to any specified ailments. The deduction has a ceiling limit of up to rupees 40,000. I'm sorry, there was a technical issue. Coming back, we were talking about ATDDB and ATU. So these two again are sections where you can claim deduction through medical treatment, the expenses that you pay through medical treatment for persons with disability and specified ailments. Again, these are sections which are usually there in front of you, but we do not make use of. But Gaurav, I still feel like I'm forgetting something. Can you help me recollect so that we can keep our viewers well informed?
Yes, Ganesh, I think we should also talk about section 24, that is interest on home loans. You have covered ATD extensively. I will try to put some light on section 24. Buying a home is one of the most common long-term investment goals. A great chunk of one's income goes towards home loan EMI. So the government has given plenty of tax benefits for house property under Section 24 of the Income Tax Act. We can claim up to 2 lakhs for the interest of home loan for self-occupied properties. This applies to vacant properties also. Before we see how Karthik and Anil had saved taxes, let us understand the tax slabs under old and new regime under Income Tax Act. These are the existing tax slabs under old and new regime with applicable surcharge and cess. Whether you should take old or new tax slabs vary on a case-to-case basis, as it depends on the deductions you are taking. It is more of a mathematical exercise. You should also know that salaried individuals can switch between the two regimes every year. This is very important. However, individuals who have income from business or profession cannot switch between the new and old regimes every year. If they opt for the new regime, such taxpayers get only one chance to go back to the old regime. So this is very important to keep a note of.
Okay, thank you, Gaurav. I think that would have been really helpful for all of viewers. Now let's get back and see how much tax did Karthik and Anil save. So you can see that both have paid tax under the old regime. You can see that Anil's tax liability is less when compared to Karthik. This is because Karthik has just utilized his PF contributions under ATC. However, Anil claims deductions under ATC, ATCCD, ATD, and so on, maximizing most of his deductions. You can see that the difference is almost 2.11 lakhs. So this happens, so you can see the difference is very huge. This would ideally help you accumulate these into a corpus. Now let us see what happens after they accumulate this corpus 5 years later and how that corpus has grown 5 years later. So 5 years later, if you can see, both have switched their jobs and their salaries have changed. Since Anil was in the practice of investing, he had accumulated a corpus of 13 lakhs just by investing the tax saved in equity instruments. Here, I would like to bring out another quote from Albert Einstein, where he said that compounding was the 8th wonder of the world. And we all know that he is right. So if they switch jobs, there are certain questions that comes to my mind. So Gaurav, could you let our viewers understand what happens to the PF? Can that be transferred?
Sure, Ganesh. See, we all know we can transfer EPF or withdraw the same while shifting job. But if you are withdrawing your EPF before completing 5 years with your previous employer, then the EPF withdrawal amount will be added to your annual income and will be taxed as per your slab. However, if you just transfer, even if 5 years is not completed, then it won't be taxed. Ganesh, we should also talk about gratuity withdrawal.
Yes, Gaurav. So first, it is important to note that gratuity is payable only on completion of 5 years of employment. On withdrawal of gratuity, such gratuity is exempted for government employees and it is taxable as per rules for private employees. So we all need to remember this as well when we switch jobs. What we all need to do to avoid tax complications while filing our returns is to submit the Form 12B to your new employer.
Ganesh, this submission of forms and all gets very confusing, and I think our viewers will also get confused. So is this form mandatory as per law?
So thank you. So actually it is not. It is not compulsory as per law. It is a voluntary form which contains the details of your previous salary, your taxable perquisites, your deductions claimed, and the tax which is already deducted. So this will help your new employer calculate the tax correctly. So this is just to make it easier for them.
So this means that one can help to avoid taking deductions twice and avoid such errors altogether.
Exactly, Gaurav. So for example, in our case, in our story, if Anil had completely utilized ATC, the deductions under ATC with his old employer, he cannot claim it further by joining his new employer in the same financial year.
Okay, thanks. So that means they should obtain both Form 16 from their employers, from both the employers?
Yes, so they should obtain details such as PAN, TAN, name, address, and all this must be reported for each employer in your tax return. So I think people now have a clarity on what we need to keep in mind when we switch jobs. I think we have spoken enough on tax on salaried income right now. Now let us move on to tax on investment income.
Sure, Ganesh. So what happens when you realize income from investments? Capital gains tax is levied. In our case, both Karthik and Anil have some savings and they invest this corpus across asset classes like real estate, gold, equities, fixed deposits, some bonds, etc. Before going forward, we would like you all to take part in the poll that will appear on your screen now. Pretty interesting statistics. So moving forward, now let's see the applicable tax rate for this asset classes. One should know that this income from investments are taxed depending upon the holding period. That is, because it is based on the holding period that they are classified as long-term or short-term. Equity instrument is considered as long-term if held for more than 12 months and short-term if it is held for less than 12 months. Also, one more important point to note is that surcharge on capital gains is limited to 15%.
Okay, thank you, Gaurav. So we looked at your taxes, how you will be taxed on your capital gains. So now we move on to how you can save taxes on your capital gains. So saving taxes on capital gains is something that we all need to pay attention to because there are a few exemptions available to you. As Gaurav had already mentioned, owning a residential property is really important for all of us. As Indians, owning a house or land is one of the first dreams that we all have once we start earning and saving money. Therefore, it is very, very important to understand how we can use the related provisions available to us to our advantage. Moving to section 54, it talks about the profit on sale of a residential house property. You can claim exemption on these gains by reinvesting in another house property in India. What you need to note here is that this exemption can only be taken if the assessee has a total of 2 houses, including the investment made on the new residential house. So, in effect, this means that if you have a total of more than 2 houses, once you buy the new house property, you would not be able to take the exemption for the gains that you had received on the sale of the first house. This exemption in this case would be the invested amount or the capital gains, whichever is lower. Let me give you a minute to process this section before we move on to the next one. Okay, moving on to section 54 EC. So let's say you have profits from your sale of property. You can invest this into 54 EC bonds like REC or NHAI bonds, and this will make you eligible to claim exemption under section 54 EC. Please note that this should be reinvested within 6 months from the date of transfer of the capital asset. Also, note that there is a lock-in period of 5 years and the exemption in these specified bonds should not exceed 50 lakhs during a financial year. So moving on to section 54F. What if the asset that you have sold is a long-term capital asset, but not a residential property? If the asset sold is a long-term capital asset other than residential property and the gains on the sale is invested in any house property in India, then you can claim exemption under section 54F. In this section, the sale consideration should be reinvested. Over here, it is very, very important for you to note that it should be the assessee's first house. Only then this exemption would be available to you. It is also important for you to note that you need to reinvest this amount under section 54 and 54F before the ITR due date to claim the exemptions. If the gains are not reinvested by the end of ITR due date, then they must be deposited in a capital gains account scheme to claim deduction under exemption under section 54 and 54F. Again, let me give you a minute to process the information on this slide before moving on to the next slide. Okay, moving on. Okay, we have discussed the tax on income and investments. So what happens to the losses incurred under different heads of income? The Income Tax Act has provisions for you to set off and carry forward your losses. Let me explain the same. So set off of losses means adjusting the losses against the profit or income of that particular year. Losses that you are not setting off against the income in the same year can be carried forward to the subsequent years. So, for instance, in the case of capital losses, these can be carried forward up to the next 8 assessment years from the assessment year in which the loss was incurred. In this case, please note that your long-term capital losses can be set off only against long-term capital gains. And your short-term capital losses can be set off against long-term capital gains as well as short-term capital gains. So this, in effect, it means that your long-term capital losses cannot be set off against your short-term capital gains. So another thing for you to ensure in this case is to file your return even if there are losses. I have many people coming to me and saying I made only losses this year or I didn't make any income this year, so why should I file my returns? It is very, very important for you to file your returns even if you have losses, because you would not be able to carry forward the losses if the return is not filed within the original tax filing due date. This is something that we would want you to keep note of because it is very, very important. Okay, let's move on. So now we can see that both Anil and Karthik have remained in this job for 10 years. And obviously, as it is the normal practice in a lot of companies, they would be entitled to ESOPs. So how do we tell our viewers about the taxation on ESOPs, Gaurav? Anything on that?
See, Ganesh, taxation for ESOP arises on two instances. First is on exercise and second is on disposal after exercise. On exercise, the difference between fair market value and exercise price will be treated as income from salary and it will be taxed as per your slab rates. So the fair market value will be derived by a registered valuer in case of an unlisted company or average traded price in case of listed entity. And on disposal, it is treated as capital gains and will be taxed as per capital gains provisions.
Okay, we can move on to the next slide, Srimati. So you can see that tax saving instruments are very important as these can help you build a retirement corpus. So as we had already mentioned, the contributions that you get like your PF, gratuity, NPF, all forms part of your core foundation and one also needs additional savings to support the core. So in this case, disciplined investing will help us achieve the target needed. As you had already seen, Anil was a very disciplined investor who regularly saved and planned his taxes. Karthik, on the other hand, did not plan his taxes and paid more tax when compared to Anil. Hence, he had a smaller corpus to support for his future years. So what we would reiterate here is please take your taxes seriously. Claim all the benefits available to you. Make sure that all your expenses that your company allows that are tax-free are optimally utilized. It all starts with understanding your salary slip completely. It is important for a prudent financial individual to understand that both tax and money is important and it is important for you to use these savings to build a corpus for your future. Thank you so much.
Thank you.